skill set with crucial knowledge and tactics and easy to follow answers to all your essential money questions. And now, your host, certified financial planner, ordained minister, multi-published author, and president of Aspire Financial Advisors, John Harrison.
Hello, and welcome to The Bottom Line. I'm John F. Harrison, your host, and I've got a question for you. When you hear the phrase, the market, as in, how did the market do today? What's going on in the market? What market do you think of? If you're like most people, you're thinking of the stock market, and that's perfectly normal. After all, every business day, the news media tells us what went on with the major stock market indexes, the Dow Jones Industrial Average, the S&P 500, the NASDAQ. So we think of the stock market as the market. But there's another market. It's actually much bigger than the stock market, and that's the bond market. If you took all the value of the outstanding stocks in the USA, it's maybe worth somewhere around $30 billion. If you took all the outstanding value of the bonds that are in existence today, it's about $40 billion, so a little more than 30% bigger than the stock market. A lot of people, individuals and institutions, putting money into the bond market. In this episode, we're going to talk about that and cover what exactly a bond is, how is it structured and graded, how is it bought and sold, how does it perform in today's economy? And if you stick around to the end, I'll tell you about a kind of bond you may not have ever heard of, but that might make a lot of sense to look at given all the chaos in today's stock and bond markets. So right after we come back from this short break, we'll dive right into the bond market right on the other side.
People say I've got a great smile. Well, I have to say, this is all thanks to the professional team at Beacon Dental Group right here in Dorchester, Massachusetts. I've got world-class dental care. Beacon Dental Group has expert and caring staff dedicated to providing the most advanced and satisfactory treatment in all aspects of oral health. Their services are designed to meet your needs and give you a perfect smile, too. General checkups, cosmetic surgery, Gemini laser service, and advanced procedures, all in a state-of-the-art facility. Call or visit Beacon Dental Group today, 1026 Blue Hill Avenue, Dorchester, Massachusetts, or call 617-282-2146 for a smile that lights the world.
Welcome back. We're about to dive into bond basics, and we're going to start with what exactly bonds are. It's a loan. A bond is a loan. When you buy a bond, you are loaning money to a bond issuer. It could be a corporation, in which case it's called a corporate bond. It could be a sector of state or local government or a government agency, in which case it's called a municipal bond. Or it could be the federal government, and we call those government bonds. But whether you're loaning to the federal government or a state government or agency or a county or local agency or to a corporation, when you buy a bond, you are loaning money to the bond issuer, and you expect to receive interest payments and eventually the principal of your loan back. Now, bonds are priced when they're newly issued. They're priced at $1,000. That's called par value. So one bond you buy for $1,000. And that's always the case if the bond is a new issue and you're buying it that way. If you're buying it on the secondary market, if you're buying it from another bond owner, that price may vary, and we'll get to that. But again, you're loaning the issuer $1,000, and they are going to promise to repay you interest, typically twice a year. The interest rate is stated as an annual rate. So if you had a bond that was $1,000 and it paid 5% interest, it would pay you $50 per year, or $25 every 6 months. And that's essentially how a bond works. That's the the idea behind it. Now, different bonds at any given time will pay different interest rates. And what determines how much they pay primarily is the credit rating of the issuer. For a corporation or a government issuing a bond, it's much like when you borrow money. If you've got a really bad FICO score, if you can borrow money at all, you have to pay really high interest rates to do it. Car loans, mortgage loans, you pay a lot because your credit score isn't very good. On the other hand, if your credit score is 780, 800, then you get the best rates available. Mortgages, car loans, credit cards, all those things. So it's much the same for bond issuers. If the issuer of the bond has very strong credit, good cash flow, all of their books look good, then they don't have to offer you a really high rate to induce you to buy the bond because people look at it as a safe investment. On the other hand, if the company is stretched a little thin and they just don't have a solid looking ability to repay, then they're going to have to offer investors a higher interest rate to get them to buy their bonds, because otherwise people would just buy the safer one if the rates were the same. So that credit rating is what affects what a bond pays. It's always a risk-reward trade-off. The higher the potential risk, the higher the payout in terms of interest that bond will offer. Either way, it's going to promise to repay you your original principal at maturity. So you buy a 30-year bond from the U.S. government or from Walt Disney Corporation or whoever issued it, and they're going to pay you that interest rate every 6 months for the life of the bond. And at the end of the 30 years, they give you your original $1,000 back. And that perceived safety is one of the things that attracts people to bonds, is that you're promised your principal back. When you buy a stock, no one's making you any promises. It's got an opportunity, but not a promise, whereas a bond has a promise of repayment. How good that promise is depends on the creditworthiness of the issuer. If it's a U.S. government bond, it's considered zero risk because the full faith and credit of the U.S. government backs that principal. Now, this is a good time to point out that that guarantee of repayment of principal applies only when we're talking about individual bonds, not bond mutual funds, not bond ETFs. Mutual funds, ETFs, all those sort of pooled investments don't have a maturity date, don't have a date in which you're guaranteed to get your principal back. So it's only when we're talking about individual bonds that we have that promise. And that's why when people get nervous in other sectors of the investment world, the stock market's got them jittery, they're nervous what's going on, people tend to run to bonds, and you hear that expression, the flight to safety, and that's what that's about. Now, you don't have to keep a bond until its maturity date. You can sell a bond anytime after you buy it, and here's where it gets tricky. Because that $1,000 that you paid for it is guaranteed to be returned to the owner at maturity. But if you sell it before it matures, you're not guaranteed to get the $1,000. And here's how this works. If while you are holding a bond, interest rates in the economy go up, then the par value, that original $1,000 nominal value of your bond, goes down. And someone who buys it from you in the secondary market will want to pay less than $1,000 for it. Why? Well, because rates are higher now, and the interest that your bond pays doesn't change in dollar terms. See, the interest rate, we used, for example, a 5% bond. It was paying $50 a year on a $1,000 investment. So that's a 5% interest rate. If, on the other hand, the price of that bond drops to $500 from $1,000, now it's a 10% payout, but it's still $50 a year. So you'll hear the expression, the yield rises. The current yield is higher when the price of the bond has fallen, and the current yield is lower when the price of the bond has risen. You'll hear the expression, the yield rose on the Treasury bond. That's just a nice way of saying the price fell. It's just a nice way of saying the bond is worth less than its $1,000 face value when the yield rises. So that language sometimes confuses people, but rising yields mean falling prices and vice versa. So we've talked about yield and price relationships. We talked about relative safety. And again, bonds feel safe, but they're not necessarily immune to volatility, because if you sell it before it matures, that price will vary. And if you've been watching the bond markets lately because of inflation, they've been taking something of a beating. So that brings us to a good rule of thumb. In terms of your long-term returns, ownership is better than loanership. I should say ownership typically pays you more than loanership. What do I mean by that? Who made more money, do you think? The people who were the owners of Amazon.com, or the people who lent Amazon.com money when they were first getting started? The owners of Facebook, or the people who lent Facebook money when it first got started? Ownership has more risks, but it typically has far more rewards than does loanership. So over the long term, if you want to build a big nest egg, you typically won't do it with bonds, even though bonds feel safer, because they preserve your currency if held to maturity, but they don't preserve your purchasing power. What do I mean by that? Well, you buy a 10-year bond, you pay $1,000 for it. It pays you interest for 10 years, and at the end of the 10 years, you get your $1,000 back. You haven't lost any currency. But do you think $1,000 10 years from now will buy as much stuff as $1,000 buys now? No, not likely. There's generally a little bit of inflation in the economy, and right now there's quite a bit. So $1,000 10 years from now is worth less than $1,000 now. And so even if a bond keeps its promises, it does not preserve your purchasing power. It just gives you your original principal back. And that is why, for staying ahead in terms of purchasing power, ownership is typically better than loanership. Now, having said all that, I should point out that there is a kind of bond that gets past some of these built-in traps, some of these built-in flaws that exist in the bond market. And that bond is a U.S. government bond called the Series I bond, I for inflation. It's a bond whose interest payments adjust to track the consumer price index. When inflation rises, so does the payout. When inflation falls, so does the payout. And unlike most bonds, unlike all the bonds we've discussed so far, the principal is guaranteed not to erode, not to fall, even if you have to sell it early, which is a unique thing. In other words, you buy a 10-year or a 20-year bond, but you have to sell it in 5. The government guarantees with the I-series bond to still give you your full principal regardless of what inflation has done in the meantime. So this can be a neat thing. It's one of the few pieces of the bond market that's not getting severely punished right now. So you want to know a little bit about the I bonds, and when we come back from our next little break in just a few seconds, I'm going to tell you the ins and outs of these I bonds so you'll know what they can do and who they can do them for. They will have a bigger impact on some investors than they do on others. But given that pretty much everything is kind of tanking right now, they can be a neat thing to put into your portfolio because they give you both inflation protection and principal protection, and that's a rare thing in the market. So we'll look into how that works after we take care of some business and pay some bills coming right up. I'll see you on the other side. So we just started talking about the I-series U.S. government bond, the inflation-adjusted bond, and why they behave differently than regular bonds, regular treasury bonds, regular municipal bonds, regular corporate bonds. They're different because inflation doesn't murder them, and they're different because you can sell them early without risk to your principal. Let me break that down in bite-sized pieces. It's designed by the federal government to track the inflation rate, and it adjusts its rate every 6 months. If you buy an I bond today, they just announced the most recent rate a couple of weeks ago now. You buy it, that rate's locked in for 6 months. At the end of that period, they'll readjust. It could stay the same. It could go up if inflation goes up. It could go down if inflation goes down. So the adjustments don't just affect newly issued I bonds. They affect all the ones that are outstanding as well. Now, the government guarantees that the principal value of your bond will not go down no matter when you sell it, as long as you keep it at least a year. If you keep it less than a year and sell it, you'll pay a penalty of 3 months worth of interest. But if you keep it at least a year, you'll keep your interest payments, and you'll always be able to redeem the principal for its full $1,000, regardless of what interest rates in the economy have done. That makes it unique in the bond world. The current rate on I bonds, I-series bonds, is 9.62%. That's surprising, isn't it? Because most things that pay you an interest rate, your bank savings account, your interest-bearing checking account, that 2 or 3 year CD, money market accounts, money market mutual funds, most cash equivalent things pay you an interest rate that's very, very low. Most short-term bonds, like U.S. Treasuries, pay you an interest rate that's very, very low. But because this is pegged to inflation, and inflation is killing us right now, I went to the gas pump recently, had a Stop and Shop card, a supermarket card that gave me 50 cents a gallon off. And with 50 cents a gallon off, my fill-up cost me $99. That was not fun. So we can see that inflation is not only affecting everything, it's really worse than the CPI is telling us. The CPI is up around 8%, Consumer Price Index, but we know that gas is up way more than 8%. We know that used cars are up way more than 8%. We know that some of the food items you buy in the supermarket, if you looked at bacon lately, that's up way more than 8%. So the general governmental figure maybe understates the pain that we're feeling, but something like this can help because it's tied at least to the CPI, and right now it's 9.62% in terms of an interest rate, and that will be what it is until the next 6-month review comes along. Well, is there a downside? Of course. There's a downside to everything, and in fact, a famous academic, Thomas Sowell, I believe it was, said there are no solutions, only trade-offs. And so there are some trade-offs involved with this too. The biggest one is that you are limited to $10,000 in purchases per calendar year of these I-series bonds. What does that mean? Well, it means that if you've got a large portfolio, if your overall investment portfolio is $500,000, $750,000, $1 million more, then the I bonds that you can buy are going to make up a very tiny percentage of your whole pie. Therefore, they won't be a game changer for you. They won't have an outsized effect on your overall portfolio rate of return because they'll be such a small percentage of it. If your portfolio is $1 million, then that $10,000 purchase limit is 1% of your portfolio. 1% is not going to have a huge effect on the whole. On the other hand, if your investable funds total $30,000 and you can put $10,000 into something that's currently paying 9% and has no principal risk, that does have a big effect on you. When all your stock-based investments, like in your 401k, have maybe been tanking, and regular bonds have been tanking because of inflation, and prices of everything are up and down. Market's hugely up one day and hugely down the next, and it's hard to keep track of the trend, but the trend has been mostly downward recently. Having something like this as a big chunk of your portfolio for the small investor can be a life-saving thing. Here's a neat thing about them, is you don't need a brokerage account somewhere. You don't need a broker or an investment advisor to get you an I-bond. You can actually go online to treasurydirect.gov. That's treasurydirect, one word, .gov, and buy these directly. The issue is that you can't have more than 10,000 in purchases per person per calendar year. So you can buy 10,000, your spouse can buy 10,000 in their own name. You can give as many of these as you like as gifts to other people if you wish to do that. But in terms of buying for your own beneficial ownership, then $10,000, and it's per calendar year, not per rolling year. So if you buy them in June, you'll be able to buy them again in January if you want to. But when you buy them in January, you have to wait till the following January. It's per calendar year. But for the person who can buy enough of these to make a difference in their portfolio, in other words, their portfolio is small enough that $10,000 worth of these has an impact, they just might be a smart place to put some money now, because you do get a return that's higher than stated inflation, and you get government guaranteed safety of principal when you sell. So that can be a pretty neat thing. Let's see if we can't summarize some. We said the bond market is a thing. You don't hear about it all the time. The news tends to concentrate on the stock market, but the bond market is there. It's big. It's bigger than the stock market. A lot of people and institutions invest in it. All sorts of institutions issue bonds for you to buy. Your state government does it, Mass municipal bonds, or Georgia municipal bonds, or New York municipal bonds. State agencies do it, the Massachusetts Turnpike Authority. In fact, if an agency that is a revenue producer, like the Turnpike Authority, it collects tolls, and those tolls go in part to the payment of its bonds, then those are called revenue bonds, and they are generally considered safer than bonds that are just backed by the creditworthiness of the agency, because there's an actual stream of income dedicated to paying these bonds. So you can get municipal bonds from an agency, or a state, or a county, or a city, or you can get corporate bonds from a company. If it's a super creditworthy, huge company, then that bond will be highly rated, and the interest rate compared to other bonds will be relatively low, but you know, it's a safe bet. If the company is not highly rated, if their finances are maybe a little on the doubtful side, then that will pay you a higher interest rate to induce you to buy, but it's a bigger risk. They call those, by the way, junk bonds, and that's where that term comes from. Bonds that the credit is so bad they're not considered investment grade are called junk bonds. And junk bonds can be a good investment for people who can stomach the extra risk they entail, but that's what they are. So government bonds, municipal bonds, corporate bonds, all of them pay you income. All of them promise to repay principal to whoever owns the bond when it matures. And all of them will be subject to price fluctuations or value fluctuations if you sell the bond before it matures. There was a time some years ago when Disney put out 100-year bonds. Not sure how many people bought those, but it's a given that the original buyer won't be the one getting that principal back. So if somebody sells it before they mature, then there is a risk of losing some of your original principal value if interest rates have gone up. That's precisely what's happening now. Interest rates have been rising. Unless we get hit with a really bad recession, they'll probably keep rising. In fact, they might keep rising even if we get hit with a really bad recession. That would be a worst case scenario. So when they rise, the price of the bonds go down, and the exception to that is the inflation-adjusted bond. And really, if you've got anywhere from $1,000 to $10,000 to put somewhere, you don't want to put it in cash, you feel like you've got enough cash reserves for emergencies, and you know that putting money in cash just loses to inflation automatically, think about the I-Series bond. Look around, go to the facts section at treasurydirect.gov and see if something like that might make sense for you. We've got to pay a couple of bills, but after this break, I'll be back to tell you a little bit more about what's coming and to give you a final thought. That's in just a moment.
The Well Jamaican Restaurant, located at 55 Mazio Drive in Randolph, Mass., where good food and fellowship meet daily. Check out our variety of fresh and tasty entrees and sides from our menu or the website, thewellja.com, like our jerk chicken, oxtails and rice, seafood, desserts, and more. With our drinks and juices made fresh daily, you have the option to dine in or take out. We can also cater your special event, or you can book our private dining room and let us host your special event. At the Well Jamaican Restaurant, we pride ourselves on providing superior quality food and beverages, and of course, great customer service. Next time you're in the mood for Jamaican cuisine, meet us at the Well Jamaican Restaurant. Become part of the family. Connect with us on Facebook and Instagram. The Well, where good food and fellowship meet daily.
Welcome back. I hope that this has been helpful information for you. And if you like our content, I want to encourage you to like the show, follow the show wherever you're getting this on social media, whether it's Facebook or you're on YouTube. Give us a like, give us a follow. Like and follow NECTN, which brings you this show and many other things. And so it really helps us grow the show. And if you're able to support, that really helps out. If you can support us financially, it will help keep the content coming. I also want to encourage you to reach out at any time to me at aspirefa.com. That's the website where you can find me. And feel free to use the contact information there. Give a call or drop a note with any questions you might have on anything covered on the show, or any things that you'd like to see covered, things you'd like to have us talk about, maybe demystify. And we're happy to take requests in that regard. Bottom line is, these are trying times for investors. We're flirting with a bear market. There's a little bit of chaos going on in the economy. People are nervous. Investor sentiment is lower than it's been in a long time. But despite the chaos and despite the jitters that are out there, you can make it. You can get where you're going financially. All you really need is a little bit of direction for the journey. And that's the bottom line.